there's also growing calls for the committee to shift its stance. Just this morning on Channels Television's breakfast program, Mrs. Kemi Adeosun, Minister of Finance, actually is hoping that the committee will lower key interest rates to, among other things, help stimulate the economy as the government plans to borrow domestically without increasing debt servicing costs. But all of this also has a very significant impression on the banks as well. And so that's what we're going to be talking about now. My next guest is the Group Managing Director of AfriInvest West Africa Limited, Mr. Ike Chioke. Mr. Chioke, good morning, and thank you so much for joining me on the program.
Good morning, Harriet. Thank you.
It's great to have you on the show, and it's a good time for us to begin to talk about the state of the banking industry. Mm-hmm. A lot has happened from between 2015
Correct.
to now. Just give us a sense of what you make about where the banks are at the moment.
Well, you have to think of the banks as a barometer of the economy. And so when the banks are doing well, you'd expect the economy to be doing well. But the banks actually started doing badly in 2015. And the trickle-down effect is what we're seeing now. And that's partly due to some of the macroeconomic changes we've seen that is now hitting most of the economy. From our analysis, we're launching our 2016 banking sector report tomorrow. We've seen that in terms of loans and advances, the industry actually declined 1.9% compared to a 27% growth in 2014. So with all the talk about lowering rates or increasing rates, the industry has not really been advancing, growing loans and advances to customers. Now, in terms of profitability, we've also seen that has come down quite significantly. Last year, with the implementation of the TSA, you saw 1.2 trillion naira of deposits neutralized in the system as that was taken away and moved into the central bank. That has had severe impact on the liquidity position of mostly of tier 2 banks. We've also seen that profits have not done as well. So all the picture that's coming out from the results of the banks from 2015 coming into half of 2016 have not been encouraging. Of course, you also note the FX volatility with the rate the divergence between the official rate and the parallel market rate up until middle of this year. Then we had introduction of the flexible exchange rate mechanism, which was supposed to help converge those two rates, but sadly, there's still not been enough support at the official window for dollars, and so you kind of continue to see this divergence with the official rate, I think, around 315 now, and
the official rate is at 307 actually,
yeah,
from the interbank foreign exchange markets, and 425
at the parallel market. So it's quite a wide band in there. So all of this is now coming in to affect the banks, because when the banks having to make most of their money from net interest income from loans and advances to clients, you see many of the sectors that they have advanced to are now in difficulty. In general commerce, because people are having difficulty getting foreign exchange to run their factories, that clearly the output has come down as a result. Costs have gone up, and therefore production volumes are down and profitability is down. You see the same thing happening in the oil and gas sector. They've been more affected by the Niger Delta issue. Now with the blockages of pipelines, people who are able to extract oil from the ground cannot export it. So that has a huge consequential effect, not just on the economy, but also many companies in the sector that have borrowed from the banking sector. So that is really also eating into their profitability.
So talking about still their profitability, at the last meeting, that's in July, the MPC harmonized rates, that's a cash reserve requirement, and made it 22.5%.
Correct.
The banks, before then, we had 25%. So there was an upward readjustment, and they were still of the opinion that it could have been better.
Correct.
And with all the scenarios that you've painted out, coming from 2015 to 2016, it seems as if that's most likely going to be what the situation is for the banks. The MPC might not move, its stance on the rates at the moment. How do you think that will affect banking confidence, banking performance?
I think that the MPC is obviously facing a different basket of problems. There are so many issues in the economy. We've just gone into a recession with the GDP growth results that came out. You have the FX divergence between the parallel market and the official market. You have inflation galloping away at 17.6%. Recall that only December last year we were at 10%. So with the MPC now trying to look at what to do, notwithstanding the clamor for a more accommodative stance in rates and maybe bringing the rates down, I think perhaps the MPC needs to think of giving investors the view that they can maintain a consistent framework for a period of time. I think what we've seen from the central bank is perhaps too many changes and quite too often. That I don't see there's a needed, a direct increase in loans and advances as a consequence of reduction in MPR. We don't see that correlation at all. However, obviously, the person that will feel the pain should be the federal government and other state governments which need to borrow directly from the markets. But I think that we need to run the economy as though it's a sort of an aircraft carrier. It's not a speedboat. So you need to kind of move in a more steady and assured way and allow certain things to settle down, but particularly the flexible FX regime, which investors are still getting up to speed with in terms of the futures, arrangements, the forwards, contracts in there. And that's sort of one of the things that CBN introduced just before the last MPC meeting, if you recall. And we're still waiting to see if external investors have keyed into that to start bringing in the dollars that the economy desperately needs.
But then you see, this already is pointing at the fact that there will definitely be low cash adequacy ratios reported by the banks.
Certainly, that's true. But there are certain other things that have. It's not so much as a cash reserve ratio. It's not. That's just not the main thing that the banks are looking at. Other aspects include liquidity and credit profile, and all of those factors come in to influence how a bank will look at a credit from their own point of view.
You already mentioned that the banks are the barometer for which you use to measure the state of the economy, if you like. So at this time, what is that barometer reading? How are investors still very confident in the banks at this time?
Well, the title of our report is Searching for Investor Confidence. I mean, by the time we put everything together, we then realized that with the devaluation of the currency, which we've witnessed, with the depressed asset prices, investors have actually gotten a double discount effect. If you're from outside of Nigeria looking at the Nigerian economy, everything's a whole lot cheaper. But we're not seeing the avalanche of inquiries. We're not seeing dollars flooding in trying to pick up shares or bonds or real estate assets or making foreign direct investments. We're not yet seeing that. And I think that is simply linked to the fact that they are not quite confident. They are not quite. There are still lingering concerns about consistency of policy. There are still concerns about the prudence of certain policies, and so our view will be for the Apex Bank and the MPC to think of maintaining things at the status quo for a period of time, and let some of the policies they've recently introduced, let them have time to settle, and people then can see that there's enough support for these policies, and it's not just going to be changed at the slightest whim and push from any other variables. And I think at that point you can then begin to see investors coming back in. But for the moment, the challenge for the economy is really how do we really engender and encourage investors to come back, and that will be helpful in stimulating the economy back on the path to growth.
But looking at that path now, looking at that blueprint that both parties are talking about, the fiscal side and the monetary side as well, and you're of the opinion that at this time policy flip-flops will not endear the investors' confidence at this time.
Absolutely.
So what should be done? And it seems to be being between the devil and the deep blue sea. You just have to make a leap, whichever way it is.
Well, the governor came out on Monday with, I think you might have seen his interview, and he was very encouraged, about what he's seeing in the economy. And he has indicated that about $1 billion has come into the system in the last couple of months, which is very positive news. But clearly, we need much more than $1 billion. But I think in terms of engendering investor confidence, we need to start at home. There are so many things that have happened that has discouraged investors domestically. And once that is removed, we can then begin to see, move forward. one area will be for them to really focus on trying to solve this Niger Delta militancy problem. A lot of companies in the oil and gas sector who are suffering significant revenue challenges are hemorrhaging. And when you see the contraction in our GDP, minus 2.1% in the last quarter, most of that was driven by the 17.5% decline in the oil sector. And that was driven mostly because of production cuts. If you actually can get the production levels back to plus 2 million barrels per day, you can see a quick positive upturn in GDP numbers. Because so far, services was down only, marginally 1.3. Manufacturing has been suffering for reasons I gave you earlier, lack of FX. But the FX is also tied to the capacity to sell crude. And we need to fix that problem. So starting domestically, trying to restore investor confidence amongst domestic players will be critical. The issues of, the anti-corruption fight is a very good one. And I think the president must sustain pressure on that. But we've also heard there's also a mixed signal approach where, innocent bystanders, a businessman buys a property and it turns out he bought from somebody who might have had some, exposure to some corrupt practices, and both the buyer and the seller are now, tied up in EFCC. Clearly, that doesn't help, in mobilizing and moving the real estate market domestically. So we would have to work with the EFCC and the authorities to be careful not to, discourage everybody from making investments if in their, search to arrest anybody that was involved in any sort of, inappropriate practices. So those kind of things are critical, because once you can get the domestic market confident, you can be sure that they'll be the ones to tell their foreign counterparts to start, that this is time the window is open. All of you should start clamoring in.
When we started this conversation, you talked about how the bank's performance was, at least for the up to the half year.
Yes.
What are your expectations for the full year, especially since, give or take, they are the heartbeat of whatever it is that we do. So whether we go forward, whether we go back, how we measure our success is tied around the financial institutions, particularly the banks. So what are your expectations for the full half of the year?
Well, we'll see their performance will sort of be flat. Although you could see numbers will seem to rise in terms of turnover or growth in risk assets, you have to recognize that half of the risk assets, in about 40% of risk assets in the banks are denominated in foreign currencies. So just the devaluation effect would mean that they have to increase the nominal amount in naira terms. So what may seem like growth is actually not growth, it's just an adjustment. We see there are certain areas, sectors that are exposed. There are significant exposure. Oil and gas remains one because of the pipeline blockages and in militancy issues. Manufacturing, for one, lack of foreign exchange. But you look at areas like power, where quite a lot of the loans were denominated in foreign currency. And you have an industry essentially running in getting revenues in naira. So with the devaluation of the naira, this kind of exposures have ballooned, unless many banks have had time, or some of those players had time to restructure those facilities back into naira. And that would have been difficult in an environment where you're looking for dollars to come in, because somebody has to provide the liquidity for that restructuring. So we see certain risk areas in the sector, in the industry exposed to the banks. I think what we will end up by the end of the year is perhaps increase in NPLs. NPLs in 2015 has already gotten to 5%, which is the threshold. We can see that perhaps bridging that gap, particularly among the mid players. We'll then see that profitability would be down, or at best flat. Obviously, people can record sort of one-time extraordinary gains from the FX, again, repricing. So people who had done some kind of Eurobond issue and have brought in dollars in their balance sheet at maybe 197 a year or two ago. Now that the exchange rate is at 305, just restating that in the books will make it look like they have performed properly, but they actually haven't. So those are some of the issues we'll see by the end of the year.
Ike, thank you so much for coming on the program this morning and, of course, sharing the perspectives. And we're looking forward to the launch of that banking sector report. It promises to be an interesting read, I'm sure.
Thank you, Harriet. It's a pleasure.
Business Morning continues after now. Stay with us.